Welcome to Alan Berry Reports TV. I'm your host, Alan Berry Labucan from AlanBerryReports.com. Well, we've certainly had some excitement in the markets these last little while, and wanted to put a show together to talk about what's been happening and where we see things going in the near term. Back when I was a teenager, I was pretty serious about hockey, and being a big guy and a tough guy, my primary job was to protect our high skilled players and cause as much trouble as I could with the other team. Now, when you're that kind of a player, you tend to be the target of the other team's big tough guys. And this one time I was skating down the ice, down the boards, and I could see one guy coming at me, and I could sort of out of the corner of my eye see another guy coming at me. And fortunately for me, just as they were getting really close to hitting me, I kind of scrunched down and got as low as I could. And the other fortunate part was they were both going to try and cross-check me in the head at the same time. So by getting down low, I dodged the cross-check of these two players, and they both smoked into each other. And as I was skating away, I kind of looked behind me, and I noticed that there were a pile of two players from the other team laying on the ice. And that's sort of how the market has felt lately. It's like one player was trying to cross-check investors was politicians with all their nonsense, and I think that there's an ample amount of blame to go around to both sides of the aisle. Their shenanigans had led to a lot of volatility and downward movement in the stock market over the last few weeks. And last Thursday I put out a report after about a 500-point down move in the market, and I was calling for some more weakness early in the morning the next day, Friday, followed by a rally, and we got that in the market. And then late in the day, the second player that's trying to cross-check us investors was Standard & Poor's. Standard & Poor's decided to downgrade the debt of the United States on Friday, and on Monday, us investors got cross-checked again with another big dip in the market. There's plenty of reasons to be negative on U.S. debt. The key reasons is that there's an abundance of debt in the treasuries and bonds too, more than there's ample debt out there. And the demand is suspect. Right now, the leading buyer of that debt is the Federal Reserve. So that's a pretty good indication that there's suspect demand. Those reasons are much more important to avoid U.S. debt than what Standard & Poor's has to say. I was online quite a bit over the weekend, and one of the key things I kept on saying was that reminding people of just how inept a job Standard & Poor's did with rating debt in the run-up to the economic calamity of 2008. And so for them to come out and make the comments that they were, I was somewhat joking and somewhat serious when I said that they should have a big disclaimer on their report that due to the inept job they did in the run-up to the economic collapse of 2008, that no investors should use their opinion when considering their investment plans, and I believe that to be true. Again, I think that there's plenty of reasons to avoid U.S. debt, but the Standard & Poor's making their comments has little impact on my view of why you should do that. And so those were the two groups that were trying to cross-check us investors, and I hope that a lot of people ducked down and tried to avoid that. And if you did, I think that things look better as we go forward. The other thing I wanted to talk about is, or another thing I wanted to talk about is also this weekend, and last show that I did on Thursday of last week, and then in my commentary on the internet over the weekend, one thing that I talked a lot about was my outlook to be bullish. And whenever the market goes through a serious drop like it did, me getting bullish is not so much about trying to make a market timing call. It seems that way to a lot of people, I believe, but actually that's not what I'm really getting at. What I'm getting at is that when investors, the best investors, the ones that have the most success with investing, are always looking for bargains. They're trying to buy things when they're trading below what the fundamentals of the really suggest that they should be trading at. These disconnects in the market happen all the time, partially because there's so much emotion in the markets often. And so the key is to be looking for bargains. And when Mr. Market gives you bargains, like when the market drops, if the fundamentals are still sound, that's a great time for investors to be getting greedy, not fearful. The trouble is that, when you hear commentators all over the media talking about how bad things are, and then people, also investors, are getting really scared, it's a difficult time to be bullish. But one of the key things I look at, there's two key things I look at during those times. One is that, what are the fundamentals looking like? And with the dramatic sell-off, companies with strong fundamentals, solid earnings growth, good margins, relatively flush with cash, are trading they're trading on sale. And the second key thing to keep in mind is that when you get spikes in the market, either a spike downward or a spike upward, I talk about this often, especially when those spikes happen, because I think it's really important for investors to keep in mind, is that those spikes never last for very long. Those are when you are running up aggressively in a spike, or down. Those are emotional moves. They're not rational moves. And so this is one of those opportunities where Mr. Market is giving you bargains, and so you want to be looking at taking advantage of that. So that's where I see things right now. I see that this big moves in the market were not so fundamentally driven. They were a lot more emotionally driven, and the key things that were causing those emotional trades is our politicians that were screwing things up and trying to cross-check us investors, or the S&P trying to screw things up by trying to cross-check us investors. And so for those that have ducked and had some cash on the sidelines, I think you can take advantage and really get some great companies on bargain prices. And so, the next question I always like to answer is where do we go from here? What's happened in the past is the past. You can't do anything about the past. Looking forward is much more important, especially if you're looking forward with a fairly rational outlook. And so going forward, some of the things that I see is, I think it's time to get bullish on stocks in general. As I said earlier, there's a lot of really high-quality companies that are trading at discounted or bargain prices right now. They're really on sale. You can look at those kind of companies. I am bearish on the U.S. debt and the U.S. dollar. I think that both of those instruments have ample supply and suspect demand. Therefore, I think you want to avoid them. I think a great way to protect yourself against weakness in the U.S. dollar is to a play against that is to be bullish on commodities. Now, not only do commodities and things like the Canadian dollar that trades is primarily a commodity-based economy, so what happens with commodities tends to be good for the Canadian dollar, and weakness in the U.S. dollar is bullish because commodities are priced in U.S. dollars. But that's not the key reason that I'm so bullish on commodities. Commodities I'm bullish on, and resource stocks by extension, the companies that go out and extract those commodities from the ground or explore or develop new deposits into new mines or producing properties. Is the key reasons is that long-term supply and demand. For many years there was a serious underinvestment in exploration to find new discoveries, then to put those into production, and this has very much weakened the supply chain of many commodities. And at the same time, you have strong demand coming from emerging and developed economies for those commodities that have weak supply chains, and this is a recipe for commodity prices to go higher, and then I believe fundamentally that they're a better asset class to own than the U.S. dollar, and I think it's a good defensive play against weakness in the U.S. dollar. So then those are some of the things that I think you can get bullish on. I'm getting really bullish on stocks in general. I think there's a lot of companies in the S&P 500 that are currently trading at bargain prices, and I also think that commodities give you defense against weakness in the U.S. dollar, plus give you exposure to emerging economy growth, which I'm very bullish on. And then you've got that demand from emerging and developed economies that are chasing after commodities that have weak supply chains. And again, that's a recipe for prices to go higher for commodities, and for high quality resource companies, that's a recipe for them to go higher as well. So in closing, I wanted to mention that again, that spikes in the market don't last long. When you get these spikes in the market, Mr. Market has given you an opportunity to buy things on sale. I think we're at that point right now. I think that the fundamentals are much better than what the current value of several stocks are, and I think it's time to get bullish when the crowd is fearful. And so, on that note, that's a wrap on the commentary. Before closing, I'd like to stress that this show and our reports are for information purposes only. We aren't making buying or selling recommendations. It's important for you to do your homework and speak with your financial advisors before making any investment decisions. We're always trying to grow our audience, and any efforts you make to email your friends or send out messages on the internet about our shows, our reports, and our website is greatly appreciated. Also want to send out some thank you messages. We use youtube.com to broadcast and produce these shows, and they make it possible for us to do these shows, so we'd like to thank them, and anybody that's interested in doing online shows, that's a great platform for you to do these, and we highly recommend them. Also, if you're watching this show on our website, you'll notice to the left and right of me that we have banner sponsors. Those banner sponsors are also really important in us being able to do the work that we do to prepare these shows, and we'd like to thank them. And also, if you want to do some homework on those companies, if you just click on the banners, they're directly linked to the company's websites, where you can get plenty of information on those companies. And of course, to you, the viewers, If you didn't watch the show and tune in, we wouldn't have a reason to do the show. So thank you very much for tuning in. Anybody that's not a subscriber to our email list and wants to be kept up to date on the work that we're doing, there's no charge to be on our email list. If you go to the website at allenberryreports.com, you'll notice that there's a subscribe button. That's where you can just subscribe at no charge for our email list. We'll keep you updated. You'll also notice on the website that we have a report section. That's where we put all of our past email newsletters. And our show section, we have a directory in there with all of our past shows, including a brief description of the show and a link to go watch the show. And so we invite you to check that stuff out. You can find all of our work on our website at allenberryreports.com. We hope you can join us for our upcoming shows. Have a great day.